Alright, this is exercise 3-4. This is the one we left off in class. I'm going to go ahead and pick up from the beginning on the problem and work it all the way through. So the facts are, on January 1st, 2010, Peach Company, they are the acquiring company, issued 1,500 of its $20 par value common shares that had a fair market value of $60 per share. They issued those shares to the shareholders of Schwartz Company as the purchase price paid for the 2,000 shares of Schwartz stock that were owned by Schwartz's shareholders. So the total amount of the consideration paid was $60 a share times 1,500 shares issued, or the total amount of consideration was $90,000. So Peach Company gave consideration worth $90,000 to the shareholder of Schwartz and received back 2,000 shares of Schwartz stock. Now we know that Schwartz has total stock outstanding with an aggregate par value of $40,000. And we know that the par value of Schwartz's common stock is $20 a share. So if you divide the total aggregate par value of the common stock outstanding by the par value per share, you see that Schwartz had outstanding 2,000 shares of common stock. So when Peach purchased those 2,000 shares of Schwartz's common stock, Peach assumed 100% level of ownership of the common stock of Schwartz Company. So up here in our CAD statement, we will enter the percentage interest acquired as 1. That's converted to percentage terms. That's 100% interest. Okay, so the purchase price that Peach paid was $90,000, so we'll enter that into the CAD purchase price column, and you see then that the total implied value obviously is 100%, because that's what 100% of the company's worth. So the implied value of Schwartz's company equity was $90,000. Okay, so part A of the problem here asks us to prepare the journal entry on Peach Company's records to record the exchange of stock. So the entry's pretty straightforward. Schwartz is going to debit their investment in sub account here, and by the way, what you see here is the consolidating worksheet, where I've added one additional column that you haven't seen before, or two additional columns rather, to reflect the journal entry that we have to make in order to record the acquisition, because these balance sheet amounts that come from over here, these balance sheet columns were immediately prior to the acquisition. So we need to update these balances that were immediately prior to the acquisition by the journal entry that Peach would have made in order to book the acquisition of the sub. So the entry is debit the sub for the cost of the sub. That was $90,000. Investment in sub debited $90,000. And we will have a credit to Peach Company's common stock account here. We'll have a credit to Peach Company's common stock amount for the aggregate par value of the shares of stock issued. Now, we issued 1,500 shares of stock to the shareholders of Schwartz Company, and the par value per share of stock, according to the facts, is $20 a share. So the credit that's necessary to be made to the P company common stock account, aggregate share par values, shares of stock issued $90,000, $30,000 rather. The excess of the issuance price of $60 a share over the par value of the stock, which is $20 a share, $1,500 shares of stock issued. That aggregate, oops, got the wrong number for the par value. The par value is $20 a share. So the excess of the issuance price over the par value of the stock multiplied times number of shares of stock issued, 60,000 goes as a credit to P company's other contributed capital. So I'm going to denote this as journal entry 1. It's the entry that is being made in order to book the acquisition of the company and the issuance of the stock. Now there's another part of the entry that we need to make as well, which is we're told up here that Peach Company incurred $1,700 of registration costs that they paid in cash. So these were costs to attorneys, filing fees with the SEC, etc., that they incurred in connection with the issuance of the stock. So they wrote a check for $1,700, credit P Company's cash $1,700, and the entry would go as an offset against P Company's contributed capital, because that's considered a part of the cost of issuing the stock. Okay, so that'll be journal entry 2. Journal entry 2. Okay, so journal entries 1 and 2 are going to be made in the accounting records of P Company. These are actual book entries. These are not just worksheet entries made as part of the preparation of the consolidated financial statements. Okay, so the next thing we need to do is we need to develop the elimination entry, and in order to do that we've got to finish out our CAD schedule up here. So the thing that we need to finish out the CAD schedule is we need to calculate the book value of Schwartz Company's equity. So the book value is Schwartz Company's equity. Well, let's see, common stock. According to the facts of the problem, Schwartz Company's common stock 40,000. So we drop that in. Again, that came from right here. We drop in other contributed capital. Other contributed capital of Schwartz Company right here, 24,000. And we drop in Schwartz Company's retained earnings here, 19,000. Okay, so the total book value of Schwartz Company's equity was 83,000. The implied value, based upon the purchase price we were willing to pay, was 90,000. So we've got a difference here, implied value in excess of book value of equity to the tune of $7,000. The facts of the problem here tell us that any difference between book value of equity and the value implied by the purchase price relates to goodwill. So that 7,000 represents goodwill that we're going to recognize as part of our elimination entry. Okay, so the elimination entry is going to consist of a credit to this investment account here in order to remove that, a debit to S Company's common stock account here of 40,000 to get rid of that. So debit that. A debit to S Company's other contributed capital in the amount of 24,000 to get rid of that. And a debit to S Company's retained earnings in the amount of 19,000 to get rid of that. And finally, one other thing, two other things. We need to recognize this excess of implied value over book value of equity. We need to recognize that ultimately is goodwill, but we're going to do it in two steps. The first step is we're going to debit it to this sort of suspense account called difference between implied value and book value. So a $7,000 debit there. Now let's do a tally here and make sure the debits and credits all equal. Okay, the debits and credits equal in our elimination entry. So this is the first elimination entry. Now the next elimination entry we have to prepare is an elimination entry that takes the balance in this suspense account, this difference between implied value and book value, and actually allocate it to the account to which it applies. And the account to which it applies is goodwill. So we're going to credit this account $7,000 and debit goodwill $7,000. You could have, if you wanted to, you could have dispensed with debiting difference between implied and book value and taken the entry directly to goodwill. That would have eliminated the need to have taken the second entry to transfer the balance of this suspense account by means of a credit over here to goodwill. But it's recommended that you use this suspense account here because in subsequent chapters when transactions get a little more complex, it'll be more useful to have that. Okay, so now our total elimination entries equal our debits and credits on the elimination entry equals debits and credits on our journal entries. I guess we should check and make sure they entry. I believe that they balance. I believe they do. They do. So now we're ready to prepare the consolidated balance sheet. So we're going to go over here and pick up P Company's cash, pick up S Company's cash, reduce it by the credit that we made to the accounting records of P Company and their general ledger to book the registration cost, and there's our consolidated cash. Accounts receivable, we're going to sum the two accounts receivable amounts. There's our total consolidated accounts receivable. We can just copy that formula down. The sum of the inventory amounts is $83,000. Copy that formula down. The sum of the PP&E amounts is $138,000. Copy the formula down to land. The sum of the land amounts is $48,000. Here we can't copy it down because we've got an entry here, so we need to take the investment in sub account of 0, increase it by the journal entry that we made to recognize the investment in sub, and then reduce it by the elimination entry that we made to offset the investment in sub account against the subsidiary company's equity accounts. And of course we've got a 0 investment balance on the consolidated balance sheet. You can see that this debit and this credit offset, so there's nothing there. Finally, goodwill. We have a $7,000 goodwill balance. So total assets on our consolidated balance sheet, $474,000. Okay, now we're ready to do the liabilities and equity section of the balance sheet. So total accounts payable, P companies plus S companies, add them together, $84,000. Combined note payable balance, $103,000. Common stock, P company had $100,000 before the transaction. They issued 30,000 par value shares of common stock. So P company's common stock, 130,000. S company's common stock had a balance of 40,000, but through the elimination process, we debited that account out, so it has 0 balance. So the only common stock that's going to appear on the company's consolidated balance sheet is the common stock of the parent company. For other contributed capital, P Company started with $60,000 before the stock issuance. They increased it by $60,000 excess of stock issuance value over par value stock, and they reduced it by $1,700 in that journal entry for the registration cost. So the other contributed capital P Company, $118,300. S Company's other contributed capital, it was $24,000 in their accounting records, but through this elimination entry we eliminated the S Company other contributed capital, so we've got none. P Company retained earnings of $39,000. S Company's retained earnings had $19,000 in their accounting records, but through the elimination process we got rid of that through the elimination entry, so no balance to report on the consolidated balance sheet. So total liabilities and equity, $474,300. So this is what the consolidated balance sheet looks like. This is the eliminations worksheet with one additional column that was added simply because we were provided with pre-acquisition balance sheet numbers, which had to be updated by means of this journal entry here that will actually be made to the accounting records of P Company's general ledger.